You are now listening to episode 26 of the Real Estate CPA podcast.
Your source for all things real estate, accounting, and tax. Here we reveal our secrets that can save you thousands in taxes, streamline your accounting process, and help grow your business. Stay tuned to hear insightful interviews with industry experts, successful real estate investors, and current clients on what strategies they use to grow their business and how they steer clear of Uncle Sam.
Hi, everyone. Thanks for tuning in. Brennan Hall and Thomas Costelli here today, and we're going to be doing something a little bit different. Today, we're going to be discussing various tax strategies and tips that can help you save money on taxes as we approach year end. This is going to be somewhat similar to the presentation portion of our virtual workshops. If you've not yet attended one of our virtual workshops, they are a highly interactive experience that puts you in a room with our real estate CPAs as well as fellow real estate investors, where we do a brief 15 to 20 minute presentation on a tax or accounting topic, and then open the room up for questions. Virtual workshops are the perfect opportunity for you to get answers to those real estate tax and accounting questions that you've been dying to ask, or you've been waiting for your CPA to email you back about, while at the same time learning about what other real estate investors are asking. You can sign up for our virtual workshops by visiting therealestatecpa.com/virtual-workshop, or by following the link in the show notes below. Without further ado, we're going to jump right into today's episode. Hey, everyone. Thanks for joining us for our year-end podcast. We're going to give you some year-end tips you need to save money on your taxes. Brennan's here with the first one.
Hey, guys. Thanks for tuning in. I appreciate everybody's time. Here with my co-host, Thomas. We're going to walk through some stuff for you. Hopefully save you a little bit of money, especially going into the holiday season. Spend some extra money on gifts rather than taxes this year, right? That's what it's all about. So first, kind of best practice that really everybody needs to be adhering to. And this is something that I've talked about over and over and over again. So if you've read my content or if you've listened to previous podcasts or webinars, you probably know what I'm about to say, but it's to itemize all of your invoices. So no matter what type of invoice you get from whoever it is, make sure that you have itemized the invoice as much as you possibly can. So I don't want to receive an invoice that says $25,000 kitchen rehab. I want to see an invoice that says we have a scope of work of a $25,000 kitchen rehab, and here's how we spent the $25,000 between materials and labor. And I want that to be very specific. The biggest reason for that is something called the de minimis safe harbor, which we will touch on in a second. But just understand that itemizing your invoices in such a way gives you flexibility. And we are really big here at our firm on gaining flexibility. So structuring your tax position so that you can be flexible at any time of the year, not just, going into December. But if you itemize your invoices, we don't have to necessarily jump on the phone in December to try to figure out what tax strategies you should be using, because we can retroactively make a look back decision. So we could be, October of next year preparing your tax returns, then look back and say, oh, well, since you itemized all your invoices, we can run a cost seg study, or like a light version of a cost seg study. Get 100% bonus depreciation, or we can use the de minimis safe harbor if the facts align. So really just creating that flexibility by itemizing all of your invoices as much as possible.
And what was awesome, we actually just went through an itemization of someone's invoice not too long ago, where we were able to identify several components of their rehab project that were eligible for the de minimis safe harbor, and we were able to save them a few bucks in taxes by using that.
Yeah, exactly. I mean, you and I, we work on all these big tax strategy clients all the time. And one of the ones that I was working with recently, he's building new projects himself, and he has all of the cost data because he's built projects himself. So he already has itemized invoices. That's what he was doing. He was itemizing all of his invoices already. So it becomes super easy at that point, because you just come in, you step in, you look at the situation, and you say, yeah, let's break this stuff out. Let's qualify for 100% bonus depreciation. But if he just paid a company to build a new house for him or a new rental property for him, and then they just told him, yeah, the cost is $200,000, not a lot that we can do there. There's no flexibility.
Awesome. So should we jump into a little bit of a low-hanging fruit here, get some of these things cleared off? So for everybody out there who's operating either a small business, or you have a rental portfolio, or you're doing fix and flips, you want to consider opening up a home office. And what a home office allows you to do, it allows you to take a deduction for a portion of your home that you exclusively use for business purposes, and is the exclusive place that you do business for your business. So it's the place where you do all the administrative tasks. You might be out in the field swinging the hammer on the fix and flips, but you come home and you handle all your bookkeeping at your desk in your home office. That'd be your home office. Some things to keep in mind with your home office: you're going to need to keep a sketch of your home office. It's going to be a sketch of your entire home. And then within that sketch will be a sketch of your home office itself with the square footage. You also want to take a photograph of that home office and keep any personal items out of there to substantiate in the event that you're ever come under an audit by the IRS. And one of the key things with the home office is not necessarily for the deduction itself. You either take a $5 per square foot safe harbor deduction, or you can use an actual method, which is going to be a portion of your expenses related to your home that relates specifically to your home office. Now, the whole entire purpose of the home office is not necessarily for the home office deductions, but rather it makes your home a place of business. And when you're traveling back and forth to your rental properties, whether that be to the rental property to do a fix and flip, or you're doing a rehab, or you're meeting with a broker, all of these now count as business travel because your home is now a place of business and you're traveling to a place of business. If you didn't have a home office, it'd be a personal commute and those miles are not deductible.
Yeah, and sometimes we get some pushback on the documentation for the home office. There's no hard and fast rules on what sort of documentation you need to have on hand, but we just say the more the merrier. So if we can have a sketch of the floor plan, where the home office is on that floor plan, even a photograph, as Tom mentioned, that type of stuff just helps solidify that deduction in case it's ever challenged. I don't know of home office deductions that have been challenged recently. I'm sure that there are some, but you just always want to be prepared. And like Thomas said, the mileage deduction, that's really kind of what the home office is for. I mean, sometimes, most of the time, actually, we'll just take the standard safe harbor, $5 per square foot for the home office itself. We're not looking to save thousands of dollars from a home office deduction, but it now makes your residence a primary place of business. So now when you're traveling from business location to business location, that's a deductible trip. Just kind of helps solidify that mileage deduction as well.
And then we have the minimum safe harbor, which kind of ties into what you were speaking about before with the itemized receipts and invoices. So yeah, the de minimis safe harbor, basically what the de minimis safe harbor does is it allows you to deduct tangible personal property that's under $2,500 per invoice line item. There is an aggregation rule. So for instance, if you're going to purchase an HVAC system, you cannot itemize each and every component of the HVAC system and then deduct the entire HVAC system underneath the de minimis safe harbor. But again, it allows that flexibility for us or whoever your CPA is to decide whether or not this component can be deducted under the de minimis safe harbor. Some common expenses that would qualify are appliances, dishwashers, refrigerators, stoves, things of that nature. All these are the type of items that would qualify under the de minimis safe harbor. So instead of having to capitalize and depreciate these items over 5 years, you could simply deduct them in that first year using the de minimis safe harbor, avoiding depreciation and recapture, and being able to cover the entire cost in full in the year you place that item into service.
Yeah, and you have to consider the unit of property that you're improving to with this stuff. So if I replace one window and that costs $300, I can use the de minimis safe harbor to deduct that one window, where in the past I would have to capitalize it to the structured unit of property. But if I'm replacing like 20 windows, that could be a material improvement to the structure itself. So then you have that anti-abuse rule that Thomas mentioned, where you can't go and itemize all the components of the HVAC. You have to take that into consideration with the unit of property that's being improved. But generally speaking, yeah, we just tell clients, think of the de minimis safe harbor, that $2,500 threshold. Think of that as a CapEx, a capitalization policy. So anything under $2,500, I'm going to write off. Anything over $2,500, I'm going to capitalize and add to the building basis. And even if you do have to capitalize something, like let's say that you put carpeting down and the carpeting costs $3,000. Well, carpet is personal property, and so even though it's over the $2,500 de minimis safe harbor, we can't write it off as a repair under the de minimis safe harbor. But because it is personal property, we can separate it out on our balance sheet and then use 100% bonus depreciation. So we're still getting the same year tax benefit. Just the difference with the bonus depreciation versus the de minimis safe harbor is that we have to recapture the bonus depreciation at some later point, where we don't have to do that with the de minimis safe harbor. But really, like, for all those folks listening here, that's why we want the flexibility with your itemized invoices. If you itemize your invoices, we can make a game time decision on whether or not we want to use the de minimis safe harbor, which generally we just automatically make that election on every single tax return unless their facts or circumstances call for some other sort of treatment. But the more that you itemize the invoices, the more flexibility we have. So more on flexibility, some more topics on flexibility is setting up a solo 401k or a self-directed IRA before year end. Actually, self-directed IRAs, you don't have to set up before year end. You have to set them up by 4/15 of the following year. But solo 401ks, you do have to have set up by year end. And what this is going to do is it's going to allow us to extend your tax returns until like October of the following year, if we so chose to do so, but make back contributions. We can retroactively make contributions to our retirement accounts. But the key is that it has to be set up. If you don't set up the retirement accounts, then we have nothing to contribute to. And then we would be looking for a next year contribution instead. So if you set up a solo 401k by December 31st, or if you set up a self-directed IRA by 4/15 of the following year, you can make contributions retroactively. So I could have a solo 401k at the CPA firm here. I could have it set up by December 31st, and I could extend my tax returns out until October of next year. And let's just say October 1st, I decide, you know what, I am going to contribute to my solo 401k from last year, and it's going to reduce last year's tax liability as a result. I can do that as long as I set up that solo 401k by December 31st of the current year, or a self-directed IRA by 4/15 of the following year.
Just to clarify some dates here for, say, someone who does not have a solo 401k, they only have a traditional 401k with their employer, their deadline to contribute is 12/31, correct? The last paycheck of that year for them.
Yeah, good point. So employees are always, even if you have a solo 401k, the employee deadline is still December 31st. So you always have to make that employee contribution, but the employer contribution can go all the way until October next year.
And for anybody out there who might be thinking of using a backdoor IRA, the thing to keep in mind there is the deadline to roll over to convert an IRA to a Roth IRA is also 12/31. So you wouldn't be able to utilize the Roth IRA strategy past 12/31 of this current tax year.
Yeah, Thomas, you're absolutely right. And what he means by the backdoor IRA method is the backdoor Roth IRA method. So it's the folks that are phased out of making contributions directly to a Roth IRA. How do they still get money into a Roth IRA? Well, you make a non-deductible contribution to a traditional IRA, and then you roll that into a Roth IRA. Now, there are a lot of pitfalls that we see a lot of our clients before they start working with us kind of go through. So one of those pitfalls is, well, I'm going to open up a traditional IRA on, 4/1, and then I'm going to roll that into a Roth IRA on 4/2. Well, there's something called the step transaction doctrine, which allows the IRS to come in and say, hey, actually, what you really meant to do is just put money into a Roth IRA. So there's no economic substance to this transaction. And as a result, we're going to disallow the transaction, and we're going to say that you just contributed money to a Roth IRA. And now you're subject to a 6% penalty of excess contributions, basically. So what we tell clients is if you are going to use any sort of backdoor Roth IRA method, first, don't ever call it a backdoor Roth IRA method. And then second, give it some time. So make that non-deductible traditional IRA contribution. Give it some time before you roll it over into a Roth IRA. We say 12 months. There's no right or wrong, but we like to be conservative, especially when we're on podcasts giving mass advice. So
Absolutely. And I think one last thing to touch on the retirement accounts is these contributions you make to your retirement accounts can lower your taxable income to the point where you may be able to get below a certain threshold or certain tax bracket. So this is the reason why you want to have this type of flexibility going, into year end and even beyond with the self-directed IRAs or the IRAs in general.
Yeah, good thought, Tom, especially with that 20% deduction, right?
So with the 20% deduction, there's two thresholds that you need to be concerned about. If you are single, the threshold is $157,500. If you're married, it's $315,000. And this is the threshold for the 20% qualified business interest deduction, which pretty much allows you to deduct 20% of your qualified business income. Once you cross these thresholds, there becomes a complicated calculation, where you basically have to take into consideration the unadjusted basis of your assets and the amount of W-2 wages your company is sending out. And it becomes less advantageous and a lot more complicated for sure. So you can keep your numbers, your taxable income below these thresholds, again, 157.5K if you're single, or 315 if you're married. It makes taking this deduction much easier.
Yeah, and you said it there at the end, but that threshold is taxable income. It's not your AGI. So taxable income is your adjusted gross income minus your itemized or standard deduction. And then you get to your taxable income. Then you factor in all your credits, like child tax credits and things like that. That comes after your taxable income. That directly offsets your actual tax. So what we're looking for is to get our taxable income, or our AGI minus our standard / itemized deductions. We want to get that down below, like Thomas said, 157.5K if you're single, 315K if you're married. But tying it all back, like if I make a $55,000 contribution to my solo 401k or self-directed IRA, that obviously helps my taxable income quite a lot, by exactly $55,000. So you can control, if you can control your taxable income. This isn't really available to folks that earn a significant amount of W-2 job. The max you can really reduce that W-2 is by contributing to a solo 401k, just the employee side of it. But if you're a business owner, you can buy a vehicle, you can buy equipment, you can prepay for subscriptions in December to drop your income enough so that your taxable income drops below those thresholds. Then if you do drop the income below those thresholds, you'll get that 20% deduction on top of everything else. You get a 20% deduction on your qualified business income that's passing through to you. So obviously pretty advantageous to keep those thresholds in mind.
Absolutely. Some good stuff for everybody out there. If you're looking to reduce it, you can use the tax. You can use your retirement account contributions, what Brandon just said. And there's also something massive, a massive thing. In fact, we like to use it. We like to call it our magic CPA wand. We like to wave this wand around, pay people massive amounts of money on taxes. And that is land conservation easements.
Yeah, land conservation easements. What podcast episode was it? 21 with Jim Sullivan? I think that's what it was.
Yeah, I think it was 21. We clarify that.
Yeah, so while Thomas is clarifying that, land conservation easements are a great way to offset your tax bill. And land conservation easements, if you contribute to one, it will come out as a charitable contribution, meaning an itemized deduction, meaning that you can use land conservation easements to further drop into those taxable income thresholds, that 157.5, that 315K if you're married. So keep that in mind too. Like if you need to control your taxable income to qualify for a QBI deduction and 20% deduction, land conservation easements can potentially help you get there.
Yep. And just to confirm, guys, it's episode 21 of the Real Estate CPA podcast. Jim Sullivan did an excellent job explaining pretty much everything you need to know about land conservation easements on that podcast.
We've been told that it's the best podcast that people have listened to in a very long time, that one single episode, and that it's the best explanation on the topic. Luckily, when we bring guests in, it's really easy because Thomas and I just ask questions that all of our clients have asked us. And so we had Jim in, and we were just able to get him to answer everything. But definitely check that one out. That's episode 21 of the Real Estate CPA podcast with Jim Sullivan, explaining how land conservation easements work. But Tom, you want to give like a quick high-level overview of what a land conservation easement is?
Yeah, absolutely. So basically what a land conservation is, high level, is you would have a piece of land that's worthy of conservation. There's some kind of historical meaning behind it. It's in a wide open space. It's something worthy to be conserved. And then you would place an easement on it. The easement would basically say that no one could ever develop on this land for all eternity, and it's now forever conserved. And for that, you're going to get a tax deduction. The tax deduction you're going to get is going to be the difference between the fair market value of the property if it was developed to its highest and best use, less the amount of land with the easement on it. And that could be quite significant in some cases. And one of the things is most people wouldn't necessarily do a land conservation easement on a piece of land they own. Instead, they might invest in a syndicate. So someone else owns a piece of land they're looking to conserve, and you would invest in return for partnership interests. And then the partnership would elect to conserve the easement. And usually it's going to be around the charitable deduction you're going to get. It's usually around 4.7 times the amount of your investment. So if you made an investment of around 50K, you get a 235K charitable deduction, which if you're over the 32% tax bracket, usually will save you quite a bit of money. I think if just the numbers off my head, at the top of the head, I think if you're in the 32% tax bracket, that would yield you a $75,000 tax savings. So if you invested 50K and you got a $75,000 tax savings, you just netted $25,000 you just saved in taxes from the government.
Yeah. So the way that it works is you would contribute the 50K to one of these syndicates. They would pass via a K1, so you'd be a partner in a syndication, and they would pass to you a K1. And on the K1, they will list out the value of the charitable contribution that you're going to be able to claim on your tax returns as a result of placing this conservation easement on the property. And as Thomas mentioned, the IRS, I think the average or the median for 2017 was $4.74 per dollar that you invest. So if you invest 100K, you get a 474K tax deduction. You invest 50, you get the 235-ish. And if you get a 235K tax deduction by investing 50K into one of these things, as Thomas said, in 32% tax bracket, you got a nice gain there. But in the 37% tax bracket, if you're now in that highest tax bracket, your tax savings from a 50K investment will be 86,950. So, and that also doesn't include states. So states treat contributions or just states treat charitable contributions differently. So it just depends on the state that you're investing in or that you live in rather, but that's just kind of icing on the cake. So it's something that allows our clients to, and anybody who invests in these things to receive a pretty immediate tax reduction. But again, going back to that 20% deduction, definitely allows you to control your taxable income, get dropped below that 157.5K, that 315K threshold if you're married, and then also get a 20% deduction on top of this charitable contribution. So now you're getting another 20% deduction on your qualified business income. So we're just stacking deductions on deductions on deductions. It's really nice. I will caveat it though, and I will say land conservation easements are risky. They are considered listed transactions. That means that you have a high chance of audit if you invest in one of these things. The syndicate is the one that's going to get audited though, so you don't necessarily have to worry about it yourself. The whole syndicate would be involved if the land conservation easement value is going to be challenged. They're not just going to challenge your one tax return. They're going to challenge the actual syndicate itself. So just be careful there, and then make sure that whoever you're investing with, if you do invest in a syndicate, make sure that they do their due diligence. I mean, this stuff is no joke. It's pretty intensive, and you need to make sure that you're getting with the right syndicate. I've had land conservation easement deals come across my desk, and I'll ask the sponsor, like, "Hey, how many of these have you done?" And he's like, "Oh, this is our second." It's like, well, I don't know if I'm sure that person could substantiate it and do it all right, but again, it's like these things are just so technical. It requires people with a lot of experience behind them to really build out and substantiate the value of that deduction. So just be really careful with who you invest in if you do decide to invest in a syndicate.
Absolutely. So there's something else that might be able to save some people, especially if you're a real estate professional, save you money come year end, and that's cost segregation. There's some strategies around there that tie in with 100% bonus depreciation on whether or not you can get the cost segregation study done by year end. If you can't get it done by year end, you might have to extend your tax return.
Yeah, so a cost segregation study, basically what that is it's taking the value of your property and it's allocating it to the different components that make up your property. So a good cost seg study is going to break out the cost of the roof, the windows, the structure, the land improvements like the parking lot or the driveway, the trees, the shrubs, all of that stuff's going to be broken out, carpeting, appliances, all that stuff. Because when you buy a property, all of those components are included in the purchase price of the property. If I buy $1 million property, it just says $1 million on my balance sheet, $1 million property on my balance sheet. If I do a cost seg study, I can break that $1 million down into all the various components. And then where it gets super beneficial, especially now with, like you said, 100% bonus depreciation, then I can take 100% bonus depreciation on any component with a useful life of less than 20 years, which with multifamily properties tends to be about 20 to 30% of the purchase price. So $1 million property, I can take a 250K, 300K tax deduction. Or if I'm syndicating it, right? If I'm a syndicate or a syndicator or a sponsor and I'm buying a big property, then that's a big tax deduction that I can push back to my investors. So really beneficial to understand what a cost segregation study is, know that that's out there. But also, if you're a limited partner and you're investing in these syndicates, ask them what their tax strategy is. You might have a syndicate that's liquidating. Say that you're invested in a syndicate and they tell you that they're going to be liquidating the deal in 2019 and your estimated pass-through, capital gains are going to be like 200K. Well, you would want to be looking in 2019 for a syndicate that's going to run a cost seg study and then pass you a large passive loss to offset the capital gain from the syndicate that you're in that's liquidating. So definitely something to keep in mind. But yeah, like Thomas said, in order to get the 100% bonus depreciation, you have to run the cost seg study in year one. So you can't file your 2018 tax returns and then run a cost seg study in 2020 and still get bonus depreciation. But you can decide, okay, we're going to run a cost seg study on our 2018 properties. You can decide that before you file your tax returns, which can be all the way up until 10/15/2019.
Yeah, so definitely want to watch out for the timing of those cost segregation studies and the sales of those properties. Is there anything else anything else we're missing?
I don't think so, man. I think we just saved everybody like $50,000. So I think that's enough.
Yeah, that's enough savings for one day.
For one podcast. Yeah, there will be more.
All right, guys. So thanks again for listening to this podcast. Hopefully we save you some money for year-end tips. And just remember, you can interact with both Brandon and I throughout these virtual workshops we'll be hosting over the coming months. This is not a webinar. It's a super interactive experience. You're going to come. We're going to do a presentation on a topic, usually about 15 to 20 minutes at most. And then we're going to open up the room for questions. And you can ask us any questions you want related to that topic. And it's going to be a perfect opportunity for you really to get those questions you've been dying to ask somebody, dying to ask CPA answered. And the best part about it is we're only going to charge you $29.99. I'm going to charge you, an arm and a leg to have us answer your questions. So we look forward to seeing you there. Again, you could find those at therealestateCPA.com/virtual-workshops. See you there.
Thanks for listening to today's show. If you enjoyed the show, please find us on iTunes and leave us a review. You can also email us at contact@therealestatecpa.com with any feedback or topic suggestions. We are always taking on new clients, and with the new tax laws in play, you really don't want to navigate this alone. Let us help you save money on taxes and with your accounting and CFO needs. To become a client, navigate to our client page at therealestatecpa.com and fill out a web form with as much detail about your situation as possible. Thanks so much for listening. Have a great rest of your week.